So today we're going to start the day by doing a tax return for Constantine Snakalakasis. This is going to be a little bit of a tricky tax return, probably one of the more complex ones we've done on these practice tax return videos. So just kind of stick with us as we go through the process, and hopefully this will be instructive for a number of different topics. So first we'll go ahead and add the client, and we can add client 11 to our practice return database. As always, we want to start out with the basic information for the taxpayer. So especially when you have a more complex situation like this, if you guys are looking at your source documents right now, you can see that this gentleman has like 3 different businesses. He also has a W-2. He has some dividend income, quite a bit of dividend income. So he's got a lot of different things going on, and it's more important than ever when you have somebody with numerous different situations on their tax return to just really start with the basics. So we want to establish, okay, he's a California resident, full year resident. That's going to be a yes. He does have a company in Alaska, so that residency issue, could be an issue. You can see on his W-2, however, from that Alaskan company that it's a California W-2. So we're going to say he's a full year resident. We got to add the California. Let's see. There we go. Alabama, no, we don't need that. Okay, so we have federal and California checked for e-file. The filing status, let's see here. Filing status for this gentleman, he is paying alimony to his ex-wife, Karen. So that's going to tell us that he is divorced, and you can see that on your client write-up. The other thing that would affect filing status, right, would be, do you have any dependents? So you supporting any other dependents? It doesn't look like from this write-up that he has other dependents. Okay, so we're going to look, it looks like he's a single taxpayer. We're going to go ahead and use the single filing status. Automatically, when you're thinking single filing status is somebody that is, making pretty good money, you're going to think, that's kind of the highest tax rate that you can be at. So that automatically is making me think, as I'm setting up the return, okay, single filing status taxpayer, good earnings, every deduction is going to be worth quite a bit because the tax rate is going to be higher. So that's what I think when I see, someone like this guy. I looked at his last year tax return, and his total income was $762,000. Okay, so higher income taxpayer like that, single, I'm thinking, high tax rate. I'm thinking that means that I need to make sure to pick up every single deduction that I can, because the higher the tax rate, the more valuable the deduction. But like I said, even if you're thinking that stuff in the back of your mind, you want to just set up the return first. Make sure the spelling of the last name, like a tricky last name like this, is correct. Don't get too caught up in all the advanced stuff right off the top here, because you really have some work to do at the initial part of the return just to set it up correctly. So his profession says businessman / investor / actor. Okay, I'm going to just go ahead and put businessman. That seems to be his primary source of income. Like on his K1, Schedule K1 from Hidden Ore Incorporated, the mining company, he has $450,000 of income. So if somebody has, multiple things that they do, and you're trying to think, what should I put for their occupation? And remember, this occupation, it shows up on page 2 of Form 1040. Okay, so it is going to the IRS. I usually put the occupation that brings them the most income. So I think for IRS purposes, that's what seems like the most logical thing to do. Okay, so date of birth. We would want to confirm the mailing address, 31282. Confirm the mailing address that is from the W-2. You can't always assume that the person's W-2 address is their correct mailing address, although usually it is. Home number, you can use 88, our Van Nuys office location, phone number. This kind of guy, we definitely would want multiple modes of contact because a busy person, they can be kind of hard to get a hold of, and definitely would want to get an email too. So because with somebody who's busier, it may be easier to get a hold of them by email than by phone. Okay, so we have some good modes of contact there. At this time, we're just kind of, going through the return, getting to know the person. If we're sitting down with this gentleman, we want to just use this, inputting the initial information, just get to know him, have a little bit of rapport, build some rapport, ask questions. We can see here that this gentleman wants to know up front how much you're going to charge him to do his tax return. So that's one of the toughest things in tax preparation is how to price tax returns, and especially as a new tax preparer, when somebody comes in and you're not really sure exactly all the work that's involved, but the person wants to get a price ahead of time, it's really can be very tricky because you don't want to over quote them the price because maybe that you won't get the business, but if you underquote it, you can really end up with situations that you don't know what you're getting involved in. Okay, and so this guy, we can see on his last year tax return, he had over $700,000 of income. So if you tell him, yeah, it's going to be $150 to do this tax return, that's probably not going to represent the real value of the tax return, and it may take you quite a while to complete it. Especially if you're a new tax preparer, you may need to get some other consulting, maybe even pay somebody else if the return turns out to be too tricky and you need help with it. So I would just say be really careful about people that want a price ahead of time. You can develop certain questions, that can help you, price out the tax return. Do you have rental property? Do you have business income? What did you pay for tax preparation last year? You can look at the person's tax return from last year, request a copy and give a price quote. Hey, if everything's the same, this is what I would charge. So people are really price sensitive and they're really price shopping on tax returns now. So generally speaking, like if you call one of the major tax preparation chains, they won't really give you a price at all. So sometimes your best approach is to not provide a price and just invite the client in. Hey, once I see everything that's involved, I'll be happy to give you a price. But like we talk about, especially with these videos aimed at, some more beginning tax preparers or people that are just getting their career started, we just want to give you some tips that are enable you to, make a living doing this. And thinking about your pricing ahead of time and what you're going to say about pricing, about when people ask for it, is an important part of your business success. Okay, so we got to check these electronic filing boxes. This is a taxpayer signature date, federal, and then state. Okay, we said we have no dependents here. We do see that he is supporting his ex-wife Karen for $3,000 a month in alimony. That will come into play when we do the deductions, because remember, alimony is a deduction. But first, before we go to deductions, let's get the income in. So let's go ahead and start with the W-2. It's usually the best place to start. And we'll go to the hidden or incorporated. Okay, retirement plan is a yes, because we can see that box is checked for retirement plan. 88,500 are the wages, and then federal withholdings 13,419. Okay, we have state withholdings, California income tax paid 7,591, and then state disability tax is 886. We always need to get that federal employer ID number in there for the federal side, and this is used for the e-filing purposes, electronic filing. And then the state also has the ID number. Employer address, also necessary for e-filing purposes. 5501. Okay, and then we see on the W-2 as well that there are some codes in box 12A and 12B. So you would go to your software program input and choose the correct codes. In this case, it's the AA. So that you can see the retirement plan that he has at work is actually a Roth 401k plan. And we can see the contribution amount, 10,500. This might come into play in terms of we're not sure whether this would be an allowable contribution because he's a high income taxpayer. So it just kind of goes to show you when you're filling out a tax return, there's different things that may pop into your mind, as you get more experienced, as you're inputting the data. But at the same time, you have to keep inputting the data and just get the translation of the source documents into your tax software first. But you also want to keep in mind some of the things that can be affected. Like I know that Roth IRAs for high earners are restricted to some degree. So I'm thinking, hey, he has a Roth 401k. We need to make sure that that is a qualified contribution. But meanwhile, I'm just going to continue to put in the information. Then we can see in 12B of the W-2, box 12B, we see a code C, which is cost of group term life insurance over $50,000. So when you have an employer that purchases a life insurance policy for an employee, the value of the life insurance policy, $50,000 or under, is not taxable income to the employee. But if it's over that amount, then it can create taxable income. And that's where this would be noted right here in box 12B of the W-2. So we got that W-2 in. Next source of income that we see here in our source documents, let's keep it in order, would be the 1099 DIV. So that tells us, okay, dividend income. We'd go down here, choose the correct input for your dividend income. And we can see that's from California Bank. That's the payer of the dividends. Total dividends, $15,439. $15,439 is the qualified portion. So again, somebody like this with a higher income, I'm thinking that these qualified dividends, because they're that lower tax rate, that's a good deal for him because his ordinary income tax rate is going to be quite high. So this lower, special privileged qualified dividends tax rate is going to be quite appealing because he's going to have a big difference between this type of income, qualified dividend income, versus ordinary income. We can see in box 2A of the 1099-D that he also has some capital gains distributions. So we'd put that in there, $5,464. We see also on box 4 of the 1099 DIV that there's some tax withheld. Okay, so we want to make sure that the taxpayer gets credit for paying that tax. And we also see some non-dividend distributions, $260. That's in box 3 of the 1099 DIV. We can also notice that there's some state income tax withheld in box 14 from the 1099 DIV. So again, we want to make sure that our taxpayer gets credit for this tax that was already taken out of this payment and already paid to the federal and state government. Okay, so got to be real detail oriented with reading the forms and get them in there. Next form that we see here would be interest income. So again, that's a specific type of income, and we need to put that in the correct place. California Bank. Okay, we're going to see interest income of $10,520. We have a early withdrawal penalty in box 2 of the 1099 INT. So that, would be different input for early withdrawal penalty depending what tax software you're using. Obviously, this is where Lacert puts it. But what this early withdrawal penalty is it's a deduction. So again, you don't want to miss it. You don't want to miss a deduction, especially when you have a taxpayer with a higher income. So this is here, see this deduction here, line 30, $529. So that's a deduction, an early withdrawal penalty. Say you have like a certificate of deposit or a CD at a bank and you take it out before the maturity date, the bank will charge you a penalty, and you get to deduct that penalty, um, essentially reducing the tax that you pay on the interest income. Okay, so again, with a higher income taxpayer, every deduction counts. You want to make sure to pick up that stuff. We can see on box 3 that the taxpayer also has some U.S. savings bonds interest, and so we can go here, U.S. bonds, $2014. The you got to realize with savings bonds or um, any debt obligation that is from the federal government, this is only taxable on the federal return. So if you put interest income in this box for regular interest income, it's going to be taxable on both the federal and the state return. For this particular type of interest income, it's only taxable on the federal return. You can't have it taxed on the state return. So again, got to make sure that you put it in the right box, but also understand why it's important that it's put in the right box, because it affects the tax treatment. Okay. We also see on box 4 that there were some federal withholdings, so some federal income tax taken out, $253 paid ahead of time out of this interest income, and then also $215 of state income tax, which is in box 13 of that 1099 INT. And what else do we see here? We see a foreign tax payment, foreign tax paid in box 6 of 1099 INT. So again, you're going to put in the amount paid because you're concerned that you want your taxpayer, you want your client to receive credit for that payment. Hey, he already paid $25 to a foreign government on this particular income. That's going to create a foreign tax credit, $25, see this, on the U.S. return, okay, lowering the tax. So this is going to lower the tax on the U.S. return, okay? So always you got to be on the lookout for anything that can benefit your client. If that's the number one thing that I could teach you guys in these videos, that it would be worthwhile, because that is the mentality of someone who's really good at doing taxes, is they're always looking for things that can save their client, you know, a few $100 here, $1,000 here, you know, even $10. Anything that you can save your client money in a legal and ethical way, that is your job. That truly is your job. So you want to just adopt that mentality as much as possible. Okay, we can see here some other forms would be there's a stock trade, so a 1099B that tells me, okay, stock trade. And remember, those type of source documents, you should memorize the source documents in terms of what they mean. A 1099B means stock trade normally, or some kind of a capital asset sale. Okay, it could be a sale of bonds as well. In this case, it looks like a stock trade of stock symbol BBRY, so that's BlackBerry. And dispositions. So number of shares, that's the quantity sold in box 1E of the 1099B. Description of property would be BBRY. Date acquired, looks like 1/1/12. And then date of sale would be 1/8/12. You're getting this information directly from the 1099B form. And sales price is $40,382. Cost basis, box 3, $15,252. So cost basis usually is what the person bought the stock for. Okay, so we can see right here, okay, he sold it for more than he bought it for. So that means that he had a profit. Okay, and then they have this new requirement on these stock trades to note whether it was reported to the IRS or not on the 1099B, whether the basis was reported. Okay, so that they noticed that a lot of people were kind of fudging the basis and, you know, trying to decrease the profit amount. The IRS didn't have a lot of visibility into what the basis was, so they started requiring that you put on the tax return whether the basis was reported on the 1099B or not. Let's see. So we have reported to IRS would be left blank. See how this little code here is blank because it does say on the 1099B that it was reported. It was reported to the IRS. This trade was, including the basis. So that's good. That's good for the IRS, that is, because they have more visibility into what the real profit was on the trade. Okay, so we want to take a look, make sure we're not missing anything on this 1099B. We can also notice one thing here is that this is going to be, it does not qualify for the special long-term capital gains rate because it was a short-term trade. See this? He only held the stock for like 7 days and made a ton of money. Okay, so it made like 25 grand in 7 days. That's a good thing, obviously. You know, he may have turned a profit on the trade, but for tax purposes, he's not going to get that lower tax rate that you would get if you held the asset for more than 1 year. Okay, this is a short-term trade. This is going to be same tax rate as his ordinary income, which for this gentleman is going to be a higher tax rate, being as he's single and he is a he has a good income. Okay, let's stay away from the mortgage interest at this point. We have the payments for tuition. That looks like for his daughter Kimberly. Okay, so we might have some questions on that, but let's hold off on that. Let's get through the rest of the income first, and now we'll go to the K1, which is the main income item for this S corporation that he owns part of. So we would go to the area of your software you input K1 in Lacert. It's right here for S corporation. The ID number, federal ID number 483915897. Name of S corporation. Okay. Place where it's filed would be Ogden. Okay. This is going to be ordinary income, quite a bit. So the company had a pretty good year, 454,000 almost of ordinary income. There's also some interest income in box 4, 2,500 bucks. Then box 7, we have a short-term capital loss. That when it's in parentheses, it means loss. So we can go ahead and put negative 528. Okay, and then we have not too much else on this S corporation K1. We can see that he is the 51% owner of the stock of the company. So that means he's the majority owner of the company. So something like that, you're just kind of trying to constantly get to know your client, what's their situation. So if he's 51% owner of the company and he has a salary from the company, you're probably thinking, you know, he's the CEO or he's somebody pretty important in the company. Now we have also his side business income, which he was nice enough, Mr. Snakalakasis, to give us a pretty good looking profit and loss statement here for the acting, and then he also has another one for consulting. We can see he has pretty considerable income from both of these. So acting looks like 65,000 and consulting looks like 50,000. So we would go over here to Schedule C, and each different business activity has its own Schedule C. So we wouldn't want to combine consulting and acting because those are two different activities. However, if you have 5 1099s, 1099 miscellaneous from 5 different acting places, you obviously wouldn't have to do 5 Schedule Cs. You would just put all of those together onto the acting Schedule C. So it goes by business activity. So actor, and then we would pick out the code for acting. Performing arts, independent artists, writers, and performers. We can see that he has a doing business as name, a DBA, which is called Professional Actors Group. So that's his name of his business. We would want to put that onto the Schedule C if he's using a business name. Okay, method be cash. Da, da, da. The amount of income, we just take it directly off of his profit and loss statement. Okay, it makes it much easier to do a Schedule C when the taxpayer brings you the profit and loss statement. So we can just go ahead and check off one by one. Okay, so he has travel, 5,548. He has, or excuse me, that's wardrobe. Travel's 10,583. Wardrobe is 5,548. Okay, we have hairpiece maintenance at $925. Not really sure if that would be a deductible expense. Is that ordinary and necessary to the production of the acting income? It could be, you know, if he has a certain part that he needs a hairpiece for, or we're not really too sure about that one. Let's say that it was related to a job that he took for for being an actor. And we can go ahead and put it on there. There would be some question though as to whether that would be deductible or not. The cell phone, we can put under telephone, and we have that as $765. Home internet is at let's see, $1208. You probably want to do a work portion of that, because remember, not all of your home internet would be deductible necessarily, because part of that is going to be most likely personal use. So that comes to that, you know, question on Schedule C of, you know, how much can you write off of one of these type of expenses that can be personal or business. And you can pretty much let the taxpayer usually, you know, be your source of information on, well, hey, how much of that is personal versus business. But it is your responsibility as a tax preparer to ask the question and just kind of point out that, you know, hey, maybe not all of your home internet is deductible, because not all of it is a business expense. So let's say that he says that it is 80% used for his acting. Okay, that would leave us with a deduction of $966. Okay, and then cable TV, that would be the same kind of thing, where I definitely would want to have a work portion of that to exclude some personal use and not use the personal use portion as a deduction. So we can see the total is $1283. Let's say it's 60% related to his acting, so that leaves us $770 as a deduction. So you can see when the person gives you a profit and loss statement, there can be some adjustments that you make as a tax preparer. You know, it's not just a simple matter of putting everything exactly as they put it into the computer. Because remember, for this type of taxpayer too, a higher income taxpayer, if you write off the entire amount, you know, deduct the entire amount of these expenses that are partly personal as well, your taxpayer can end up in a situation where, let's say, you know, God forbid that they got audited and they are found to have taken all of the internet and all of the cable TV as a deduction. Because they're a higher income taxpayer, their chance of audit is much more significant. And we can take a quick look at some statistics on that, just to get familiar with that. Okay, so let's take a look at this Kiplinger.com article. Okay, it came out April 2nd, 2013, so pretty recent. Okay, so you got about 1 in 100 chance of being audited. Those are the general audit rates. It's about right, about 1%. So not an overwhelming risk. However, let's check out this. Well, I'm just going to go ahead and directly search it. chances of audit for high earning taxpayer. And we'll just see how this changes. Just get familiar with, a lot of people, especially higher income people, are concerned about being audited. So you want to kind of have some data that's in your mind about what the real chances are. Okay, so we see here probability of being audited is highest for high income taxpayers. About 12% of individuals who had more than 1 million were audited. Okay, so that shows us that there's, generally speaking, about 12. If your normal audit odds are 1 out of 100, it's about 12 times those odds for a higher earning person, especially over $1 million of income. So I don't think he'll get to $1 million of income this year. It doesn't look like, but still, the point remains valid that you don't want to expose your client to any undue risks. We can see here that his self-employed health insurance. Okay, he has health insurance too on this profit and loss for acting of $6,059. So that's actually not a Schedule C deduction. That's going to be an adjustment to income. Okay, and we could find that, or the self-employed health insurance. Okay, let's see, $6,059. That's his insurance premium. And let's see, we want to read, make sure that we are showing up. Okay, so here's that deduction, line 29. It's an adjustment to income deduction. Whenever we put that, data entry side of it, if we have any questions, we can always read the forms. Okay, this is how it works in Lacert tax software, but other forms of tax software should be the same, where they offer you the ability to once you've input the information, to read it and make sure that it's landing in the correct place. So we go back to the Schedule C, and we can see that there are also some SAG dues, so Screen Actors Guild. So that would be dues and subscriptions. Screen Actors Guild dues. That is going to be $608. And then we have, last but not least, some headshots for Constantine. So a lot of actors would have expenses for headshots that they can use for marketing themselves. Okay, so that's the Schedule C for the acting activity. And you might have some other questions about vehicle expense or possible other expenses that you would work through with the client. Hey, what about this? What about that? You can use an internet resource like we have some entertainment. We have some list of deductions for different professions on our website. So you can see here tax deductions for various jobs. Okay, and these are the jobs where we put out free lists of different deductions. So you might use a research like a tool like this to get a list of deductions, to be able to ask that client about what they're doing. We can see here number 13 is entertainment for our actor clients. So you can pull that up, and you would see, hey, what about all these other ones? Anything else like this? Anything else like that? And really work through, trade publications. Do you receive, you subscribe to Entertainment Weekly or subscribe to Variety? Any of the entertainment, entertainment publications, you subscribe to any of that? What about any software? Did you buy any software or any subscriptions to help you get more acting roles, or whatever the case may be? You want to spend some time going through these potential deductions. Not going to apply every time, but when the person has a higher tax rate, like this guy, because he's have a higher income, each of those deductions is going to matter more, so it's going to save your client more money. Let's say for the time being, though, that that's all the deductions on Schedule C. We would then go over and do another Schedule C for the consulting. Okay, for the consulting activity. And we would want to find out what type of consulting it is, because that's really going to depend the code that it goes into. Let's say that he's doing, what kind of consulting would a guy like this be doing? Probably something in the finance area. So you would want to find a good code for that. Accommodation, no. Okay, let's say he's doing consulting for real estate related, land subdivision, let's say. Since he has the experience with his mining company, maybe that would be a type of consulting that he would be helpful for. Whatever the case may be, you just want to find a good code to put in here. And like we said, when we gave you these practice tax returns, anything that you don't know or that is not apparent, just go ahead and make it up. Okay. A lot of times in tax preparation, you're dealing with incomplete information, so that'll kind of orient you to the reality of doing taxes. You want to get any information that you need from the client. You know, tax preparers can rely on information provided by the client in good faith. Okay. So your place where you want to get this information that you need is from the client, obviously. Okay. So he has a profit and loss for his consulting as well. He has income of $50,529. He has some advertising expense of $3,452. Okay, he has some car expense of $5,683. Supposed to do the mileage or actual expenses on that and actually fill out a little more detail instead of just putting the car expense like directly on the Schedule C. So see this car and truck expenses, if you try to plug this in, $5,683. You go to diagnostics, says auto and truck expenses require evidence to support the deduction. Failure to provide this support on Schedule C, Part 4, will cause the return to be rejected by the IRS. So in other words, you have to provide a little bit more detail about what the vehicle is as opposed to just plugging in the expenses into Schedule C. And whenever usually the IRS is demanding more detail on something, it usually means because they're having trouble with people either exaggerating the deduction or not somehow they feel like they're losing money by not demanding more detail. So that's generally when more details are demanded, it's because there's a tax collection potential there. In this case, they want to see which vehicle is being used, okay, and so that they can track the vehicle mileage and the deduction itself. So vehicle used by more than 5% owner, yes. Off-duty, yes. He probably has another vehicle. No, we won't check that. And let's say it's a 2008 Jaguar. Okay, date, place, and service. He started doing this activity on the 3rd of April of 2007, so he's been consulting for a little while. Total mileage, let's say it's 12,419, and the business mileage is going to be a portion of that total mileage. The thing that's a little tricky with this car expense, though, is that he already has a figure down here, car expense $5,683. So what we want to get from him is, where are you getting that? Where are you getting that number? What's the source of that? Is that like you added up all your gas receipts and car receipts, or and car repair receipts? Or did you use the standard mileage rate that's given by the IRS? How exactly did you arrive at that number, 5,683? Once we figured out how the taxpayer arrived at it, as tax preparers, we could then, see, hey, is the way that the taxpayer calculated that vehicle expense, is that a valid way to do it? Is that going to pass muster with the IRS? Do we want to make some kind of adjustments? Do we need to make some kind of adjustments to it to be in line with IRS regulations? So not every time when the taxpayer gives you information does the taxpayer know what they're doing, at that, to say the least. So he could have pulled that number from, from anywhere. We need to figure out whether that's a legitimate number or not in terms of how it matches up with the IRS um, regulation. So let's say that the car expense, let's say that he did use the mileage rate, which is 55.5 cents per mile. Let's see if we can get 56.83 divided by 55. Wait, no, that wouldn't be right. So 5,683 is the total expense divided by 0.555. That's not right. How would we get that? That would be... Okay, so I have total expense of 5,683. How would I divide that? So 5,683 divided by 0.555. Okay, so that would be total miles of 10,239 would give us that deduction. Does that make sense, guys? 10,239. You're kind of trying to reverse engineer and figure out, okay, if he used that mileage rate, 55.5 cents per mile, and he came out with a figure of 5,683 for deduction, that would mean that this is the mileage, and you could test it back the other way by timesing it by 0.555. Yeah, so that's the deduction figure. So if we had that in as the deductible miles, we could look on the Schedule C and see, okay, here's the deduction amount. So you're kind of trying to test it. You need to just be able to be a problem solver when you're doing a tax return. That's a little example of something that you might need to do some figuring. But all in all, it's the same deduction, and it's also helped us get rid of. Okay, so now we don't see that diagnostic telling us that we need more details, because if we look on Schedule C, page 2, here's that part 4 of the consulting Schedule C. This is what it was asking for, part 4, information on your vehicle. It needs this more information in order to credit us for the deduction. Okay, so it needs to see, hey, how much how much mileage did you not write off? Okay, how much did you write off? When was the date placed in service? Those are details that the IRS wants about that deduction. So if we go back now to the Schedule C for the consulting, we address the vehicle, the telephone, $12.88. We may want to ask about, hey, is that personal use as well, or is that all business? That would come to that same point about excluding the personal use portion and getting to a business use portion as a deduction. We see some accounting software, $299. Okay, sounds like a deductible expense. Bad debt from clients. So debt that wasn't collected but was reported up in this figure here would be a write-off. 588. Seminars, looked like a lot of seminar expense. So 25 grand. So that could have been a couple really expensive seminars. We're not sure, it's not our job to really tell this taxpayer what's necessary and ordinary necessary for their production of income. So if he's going to seminars for $25,000 a year, and he's telling us these are business-related seminars, and it seems to make sense to us that they would be, we're okay to put this deduction down based on what the taxpayer is saying. We always got to keep in mind that our role is to fill out the tax return and achieve that balance between maximizing the client benefit and then staying, sort of coloring within the lines as far as the IRS and staying legal with the IRS. That's that balance between maximizing client benefit and obeying the rules of the IRS. That's your challenge as a tax preparer. So within that, relying on the client information and what's provided to you is a very key part of that, because that enables the taxpayer to realize that hey, this is my tax return, and I'm taking responsibility for what's on it. You always want to keep that in mind when you're dealing with clients, because that's a very, very important part of the process is who's ultimately responsible for the accuracy of the tax return. It's, you definitely should do your best job as a tax preparer every time, obviously, but the person who's ultimately responsible is the taxpayer. So they deserve to understand that ahead of time. We also have some travel expense on here, 4,597, and we also have some meals and entertainment of $1,867. Okay, so what's the difference between this travel box right here and meals and entertainment? Is that meals and entertainment, you're only going to get 50% of the deduction. Travel, you'll get 100%. And let's look at that at the Schedule C to see how that works. See? So here's the travel, you get the full deduction. Meals and entertainment, it chops it in half, so you only get half the deduction. Okay? 50%, and then we also have some books. So books related to consulting or related to the type of consulting that this taxpayer does came out to $650. Okay? And again, we may want to, spend some time, if this is our real client, spend some time going through other possible deductions that could apply to either, the acting or their consulting, try to get a few more deductions. But for now, let's keep moving on and say, that's all the deductions that we're going to get on Schedule C for each one. And we just want to kind of, take a look and see what does the net profit look like. So here's the acting Schedule C, 65,000 income, deductions, not a ton of deductions, so we have a profit of 43,000. So yeah, we have some pretty good profit on that one. What about the consulting? Okay, we have 50,000 of total income. We have some advertising on this one. We have vehicle expense, travel, quite a bit more expenses and deductions. Especially that seminar deduction was a big deal, 25,000. So you can see the expenses are quite a bit more. The net profit is quite a bit less. Okay, so when you're working through the tax return, especially with a Schedule C or a Schedule E for a rental, after you're done inputting the information, for me, I always like to try to look at the information and read it and say, like, hey, is this business, making a lot of money? They have a lot of net profit? What's the percentage of the deductions that are relative to the income level? Those are kind of key factors that you want to look at as you prepare a tax return. At this point, you want to ask the taxpayer, especially a taxpayer that has a lot of other stuff going on, any other income. Any other, actually, you know what? Before we get to that any other income, we have a home office deduction for the acting business. And I didn't see that on the write-up, but I see that now. He says, take that from my last year's tax return. So provided you with the 2011 tax return here, and we can go ahead and look at that form, which would be Form 8829, right? And we're going to use basically the same information as last year. So we would go here, point it to the correct Schedule C, which is for acting. Okay, business youth area is 529. Total area is 3,582. I'm taking this from the 2011 tax return, guys. And let's see. This one's a little bit tricky because I see that there's some carryover of unallowed expenses. So I would want to put that in here. This is a carryover. I don't want to miss that deduction, 3,141. So that's going to be carried over because that particular year he didn't have a profit from the acting, or he didn't have enough profit to use up that home office deduction. Let me just verify. Yeah, so that's an amount to be carried over. We don't want to miss out on that deduction. And then on the home office portion for the indirect expenses, that's going to be anything that is going to apply that business use percentage. The big one on that looks like it's going to be mortgage interest to this California bank. So we have a 1098 from the bank showing, hey, I paid $25,371. I also paid $4,539 of real estate taxes. Okay. Lacert makes an interesting way to handle this home office area, which your software may handle it a little bit differently. And what it does is on the 8829, the home office form, it takes the business use percentage of the interest, let's say, okay, and it divides it, and it puts, here's the business use percentage, 3,747. So that deduction is going to go to the Schedule C for the acting Schedule C, whereas the rest of the mortgage interest is going to carry over automatically to the Schedule A. Okay, and same with the real estate taxes, where it takes a portion of that. It takes this business use percentage right here, this 14.77%, and then it puts the rest of the deduction over to the Schedule A. So see this? Here's the rest of the home office deduction, or the mortgage interest deduction. Okay, so that's an interesting way that Lacert kind of handles it, of allotting part of that deduction onto Schedule C and putting the rest of it automatically onto Schedule A. Your software may handle that a little bit differently, but you should get the general idea is that the business use or the home office percentage is that deduction is gonna go to Schedule C, whereas for the rest of the mortgage interest and property taxes, that would go to the Schedule A, which is normally where mortgage interest and property taxes goes. So wanted to point that out. Homeowners insurance would also be potentially deductible. You can see last year, okay, it was $995. Let's say it's $999, $998 this year. And other expenses, let's say utilities, for a larger house like this, okay, 3,500 square feet, you're probably looking at $250 a month or something like that. And let's say there was some repairs and maintenance that he did to $2,059. So people would say, are home repairs deductible? And normally, right, they would not be deductible to your personal home. But if you have a home office and you have some repairs, you could possibly get a portion of those home repair deductions, a portion of those home repair expenses as a deduction through the home office. Okay, so if it's $2,059 is the total expense, and then you have this portion of it which could be deductible on Schedule C. Okay, not going to make a humongous difference a lot of times, but again, every dollar counts for the taxpayer that has a higher marginal tax rate. Those deductions are worth good money, okay, even if it's not a humongous amount. Okay, I wanted to point that out. So you can see this guy has a pretty tricky tax return overall. And I want to look now at this issue when we ask him about, okay, any other income. And let's see, for the acting Schedule C, let's look at that home office deduction, see how much that is worth. Okay, see this? $8,000 deduction. Okay, that's a pretty big deduction for that acting Schedule C. Okay, so part of this being able to correctly and to the taxpayer's maximum benefit fill out this tax return, part of it's going to have to do with handling the home office deduction correctly. You may hear that home office deduction is sort of a red flag of an audit. That's not really my experience. I haven't seen a lot of home offices get audited, other than home offices that are, where the 8829 is not filled out correctly. So, for instance, if you're taking 100%, business use percentage, or, you have you have another place of work that you're working, and you're it's just not legitimate that you have a home office. So I would say the home office is only a red flag if it's being misused in this case. If he does all of his bookkeeping and searching for jobs, searching for acting jobs out of a home office, and he has regular and exclusive use of that home office for this purpose, then it seems like it would be a legitimate deduction. Okay. At this point, when we've done this much, we want to make sure, hey, any other income? Because it says on this write-up, he holds many investments. So many investments could be, maybe he doesn't have all his paperwork that day in front of you. Just because the client doesn't have all the paperwork in front of you doesn't mean that there haven't been other income sources reported to the IRS or that exist. So we want to definitely check that out. And then we also see on the owns a small rental property in Wyoming that he also uses as a vacation home. Okay, so that is going to be rental, Schedule E, right? And let's see here. We could take the property address for that rental property and the basic information from last year's tax return. So never underestimate last year's tax return is a great source of information. And you definitely, with a more complex tax return like this, you definitely would want to request a copy of last year's tax return, because that's going to give you a great idea of what the person's been doing and what they're likely to do again. So single family residence, and it would be Jackson Hole, Wyoming, 83001. Type of property, single family residence. So we're filling out the Schedule E now. Let's see this number of days rented here. So that's going to have to do with this idea of the rental property also being a vacation home. There's specific rules regarding vacation homes and rentals. So vacation home rules. Okay, renting your vacation home. We can look straight at the IRS website. Okay, part of the rules on that is that if you only rent the property for only a short time, you may not even be required to report the rental income. Okay, so that's one big thing that just jumps out at us right away. The other thing is that when you use a vacation home as your residence and also rent it to others, you must divide the expenses between rental use and personal use, and you can't deduct the rental portion in excess of the rental income. So in other words, you can't take a loss on it. And what specifically that means is you are considered to use the property at a residence if your personal use is more than 14 days or more than 10% of the total days is rented to others, if that figure is greater. For example, if you live in your vacation home for 17 days and rent it for 160 days, the property is considered a residence because that would be more, right? 17 is more than 10%. Okay, so that's basically trying to determine both the income reporting requirement. So hey, does this guy even need to report this rental income? Maybe not, because there's these special rules for the for the rentals that are also used as a vacation home. If it does need to be reported, you may not be able to take all of the deductions for that rental property if the personal use is above a certain limit. So it's just telling you to kind of be careful about it. And you can see here a special rule for limited rental use. You use a vacation home for fewer than 15 days, you do not have to report any income. Okay, so we would want to ask the person to that point, hey, how many days did you rent it? And you just say, I rented it quite a bit. Like last year, you can see that he had $32,500 of rental income from it. So that's a pretty good number of days that he would rent. Let's say he rented it for 200 days. That's going to tell us that we cannot take all of the deductions associated with this property if the taxpayer used the property for personal use more than 14 days. Okay, so once we determine how many days it was rented, then we would ask the taxpayer, how many days did you use it for vacation? And let's say that he just says, I only use it for a week each year. A guy like this that's a savvy person, a lot of times he'll know what the rules are about that, and so then that enables him to take the full deduction for the expenses because his personal use is limited, okay? And ideally for the rental home, he would use, let's see, so he had a profit, other total expenses 25. Yeah, so he had a profit on last year on the rental on Schedule E from the rental activity. The reason I'm looking at that is because I'm concerned about those passive activity loss limitations. If he had a loss, maybe he has a carryover loss because he wasn't able to use that the year before. Just kind of trying to read the last year's tax return and see if there's anything that I need to be aware of as far as any carryover items that I should move to this year. Let's say for this year that he's rented it 34,000. Ideally, he would give you a profit and loss statement for the rental property as well, just like he did with the business. Like we've been saying, though, if you're not provided the information on these practice tax returns, that's why they call it practice. So it's for you can go ahead and make up the information and be able to fill out the tax return in a way that is instructive. And if we're using last year as a guide, we can see that the association dues for this property were quite expensive, so about over 18,000. We also had some travel to the property, so we can keep it, fairly standard towards last year. Let's say we have some insurance. Insurance expense is that's always going to be the case. You can't really get a mortgage or get by in anything these days, it seems like, without insurance, so that's going to be a pretty steady expense. We also have some, let's say there's a legal and professional attorney, 1 hour, $200. Let's see, any other, okay, yeah, property taxes would pretty much always be something too that would be a deduction. Let's say there was a little bit of repairs, 529. Okay, now I inputted the information on Schedule E. I now want to read the information. So I'll go to Schedule E. Hey, does this look right? Fair rental days, yeah. Personal use days. Let me see where that personal use days. Personal use days is going to be 7. So I want to add that in there. Okay, 7 days. That means, hey, IRS, I didn't use it more than 14 days. I didn't trigger those other special rules. Okay, we got the rents received. We have all the other expenses. The one thing that we're missing is we can see on line 18 for the depreciation. Last year was 2,760. This year we don't have that in there yet because this is a new client for us. So we haven't set up that depreciation yet. And the way that we're going to do that is we're going to reverse engineer it, kind of like we did with the mileage for this guy. And we're going to say, okay, 2,760. This is a residential property, right? So we know that it's 27.5 years is a recovery period. So that means the basis, depreciable basis, should be 75,900. And let's see if that's the case. If we go to here to depreciation, okay, it's going to be 1416 Wyoming Avenue, rental, or we can do single family residence. Okay, form, okay, that's fine. Category is going to be buildings. Date placed in service, let's say he's been renting it for quite a while. He started at, we would have to get this information obviously from the client. Let's say he started renting it 2005, and let's try that. What was it, 75,900? Let's see. And then method is always going to be for residential rental property, 27.5 years. So let's see if that gives us the correct deduction. Yeah, it does. So 2,760, and that's going to match up with last year's depreciation deduction. Okay, so that's going to tell us that we're on the right track. We just set up the depreciation correctly. Again, that's a little example of kind of being a problem solver and being able to act with incomplete information. You know, not every client's going to hand you everything on a silver platter. Okay, and again, that's an understatement. People bring you situations where you have to kind of try to figure out what's the correct way to address it. 75. And you may also, with the depreciation, you can ask for what's called the depreciation schedule from the prior year. The tax return or the taxpayer's copy of the tax return a lot of times should have that in there, and you could take the figure directly off that. Like I see on here that it's 75,913 is the correct basis off the depreciation schedules. That's going to be, yeah, same deduction. Okay, so this is a pretty interesting tax return. I want to look over and see one other thing on last year's tax return that jumps out at me as I see a negative 3,000 on line 13. So that would be a capital loss, and that's telling me, hey, maybe there's a leftover capital loss, which there is. If you look on the 2011, you can see net long-term capital loss is 299,000. Okay, so we would definitely want to get that carryover loss in here, because that will erase part of the gain from any future year, from this year or any future year. So I want to go here to dispositions. I want to go to carryover loss, and then it's going to be a long-term loss. So it would be carryover loss, net long-term gain. Guys, you just got to be a little detail-oriented on this. Looks like there's $269,535 of loss left over. Okay, I just want to read that and see if that's carrying over. Okay, yeah, see how this is going to actually, here's the Schedule D. Here's the Schedule D, guys. And so we have this big gain, right, from that. You sold that BlackBerry stock, made 25,000. Okay, there was a little bit of a capital loss, short-term capital loss from the S corporation, if you remember that. But we still have a big gain here. But then when we come here to the capital loss carryover, we have a lot left over, which not only gets rid of this capital gain distribution, it also eats up the other gain, that $25,000 gain. Okay? So in other words, by picking up this capital loss, we have essentially avoided income tax on the gain of that $25,000 stock gain. Okay? So that would be something that if we missed that on this tax return, there would be a major, the person would pay a lot more tax because we missed that. But fortunately, I didn't confuse myself too bad on this tax return, and I vaguely remembered that I could have thrown in another curveball to you guys to cover that, to address that, enable us to bring that out. Okay, so if you don't have this carryover loss here, and you don't pick it up from the year before, I hope you get what I'm saying here, that the person would end up paying income tax that they don't need to pay. You know, aka that you're not doing the best job that you can for your client. Okay, so you need to always be able to read that and make an effort to read the last year's tax return, and always search for any possible deductions that could be carried over. On this tax return, we've seen a couple of them, actually 3 of them. The depreciation deduction from the rental, we had to pick that up as a carryover item. The home office deduction that was carried over, we had to pick that up, and then this capital loss that was carried over from 2011. So those are 3 things that if we didn't pick those up, we'd be missing deductions for this taxpayer, which we definitely don't want to do. This guy's going to need all the deductions that he can get. Okay, speaking of deductions, we also want to make sure that he gets the adjustment to income for the alimony paid. Okay, so that's going to be Karen. She would have to give us her social. And amount paid, $3,000 a month, is going to be $36,000. So we want to read it. Hey, is that coming out correctly on the 1040? It is. Here's the deduction. Here's Karen's social. Okay, it's good. Always good to read it after we've inputted it and make sure that it's showing up correctly and there's no issues with it. Okay, so that's another big deduction. Okay, pays student loan interest for his daughter in the amount of $3,987 for the year, so pretty much student loan interest for his daughter. And we can also see that we have a 1098T. 1098T for his daughter, which is $25,050. So that's a pretty sizable amount that he paid for Kimberly, and looks like she is in college. However, we have to determine whether or not she's his dependent, because if she's not his dependent, he cannot claim those expenses. He can't claim the school-related expenses unless she is his dependent. Although I do want to double-check one thing on the student loan interest. Can you claim student loan interest paid as deduction for non-dependent? Okay, so let's see if we can get a decent search result on that. And I believe it's that as long as the person was the dependent at the time they were going to school, that you can. Okay. But I would want to get a better student loan interest. For you, okay. So yeah, qualified student loan is one who was your dependent when you took out the loan. Okay, so even if the person's not a dependent now, were they a dependent when the loan was taken out? If so, you could still be able to claim the student loan interest even though they may not be a dependent now. For the possible tax credit or other tax benefit for the current tuition being paid, that it needs to be, Kimberly would have to be Constantine's dependent in order for him to claim that credit, the American Opportunity Credit or any other education credit. In this case, Kimberly, we're going to say, is living with the mom, and so ordinarily the custodial parent, where the dependent's living or where the child's living, has the automatic right to claim the dependent. So we're going to say that Constantine does not have the right to claim Kimberly as a dependent, his daughter, and therefore these expenses for school are not really going to play into the tax return. It's definitely something that we would want to look at and then take an appropriate process to see, hey, is there a deduction there? Is there a credit there? Again, you're always working on behalf of the client, but you're trying to match that up and say, do your research. Okay, I looked on the IRS website and I determined that you can take this as a deduction, or you can't, or you know what I mean? You got to have that process of where you're subjecting your desire for the client to get a deduction. You're matching that with the need for you to follow the IRS rules. And with following the IRS rules, you're not really, you are concerned about being perceived as an ethical tax preparer and keeping your integrity with the client, but you're doing that and following the rules for the protection of your client. So keep that in mind as well, is that you're working for their best interests. It's not that you're trying to prevent them from being able to claim deductions. You just don't want to put them in a position where they're exposed to any risk if they got audited, or if they are exposed to any risk, that it's a risk that is, you would have a good chance of arguing that, that it was legitimate. You don't want to put out deductions there and expose your clients to risk, because again, it's your job to know the rules. The client, a lot of times they don't either won't know what the rules are, or they'll know them very imperfectly and not really know all the details about it. So you're acting ethically and with integrity to protect your client. It's not only out of a desire to stay out of trouble yourself, although that's important as well. Okay, I'm looking over these remaining. I also want to fill out the Schedule A, complete filling out the Schedule A, and we can see here he pays the therapist $2,000 a month for extensive psychoanalysis. Okay, so that's potential medical expense deduction. Before I do any medical expense deduction work, I want to see what the adjusted gross income is. So it's $576,000, because remember, the medical is only going to be deductible on Schedule A if it's over 7.5%, and this is for 2012, it's over 7.5% times 0.075 of the adjusted gross income. So we need more than $43,000 of the medical expense deduction to get any deduction. So we could go ahead and, just for the heck of it, plug in the psychiatrist bills, psychologist bills, $24,000. But if we go over to this Schedule A, we're going to see a big goose egg here, a big zero, because it's not over that 43,000 figure. Okay, and with the new healthcare law for 2013, it looks like they're raising this percentage to 10%. Okay, so they're making that threshold even higher for the medical expenses. Okay, so we don't need to worry about, unless there's a lot of other, very costly medical stuff, big surgeries and that kind of thing, we're not going to be able to use this medical deduction. We are going to be able to use the state and local income taxes. You can see that here. That's the deduction on Schedule A, this 9,000 figure, as well as the real estate taxes that carried over from the home office form. The car registration, the personal property tax portion, let's say it's 524. And charity, let's say he's pretty generous. He gives $3,000 cash, and he also donated some Salvation Army items worth $250. Okay, so that would be his Schedule A. And we're still thinking, okay, any other deductions? Anything else? Any other deductions? Any credits? Any tax credits? We're moving on to tax credits. We want to explore this. Any credits that he could qualify for. The foreign tax credit we already saw. And we could double check that that's in play on page 2 of Form 1040. Okay, so we have that credit. It's only $25, but again, that's something. $25. Okay, any other credits that he might qualify for? Adopt any children, education credits, we already ruled that out because his daughter's not a dependent. He's obviously not going to get earned income credit. We just want to spend some time looking at other credits, possibly, but let's say that he doesn't have any other he's going to qualify for. We now know that we're approaching the end of this tax return, which you may at this point be saying, thank God that we're coming to the end. We are getting close to the end. We do see one other thing, though, that he pays large quarterly tax payments to cover the tax on the business profit. He paid $50,000 each quarter to the federal and $10,000 each quarter to California. And you can see that on the 2011 tax return. On line 63, he paid estimated tax payments of $240,000. So that means, hey, he knows he has a very profitable business, and he's getting out ahead of it and paying the estimated tax that he needs to pay. You need, as a tax preparer, to go in there, in Lacert's case, it's screen 6, estimated tax payments, and credit the taxpayer for those payments. So on the federal side, see how this is federal right here? He paid $50,000 each quarter, and let's say he paid it on time. $50,000, and fourth quarter. Okay, 01, 15, 13, and then on the state side, Let's say you paid 10,000 each time. 615, not 415. 10,000. California actually has a weird deal where you're supposed to not pay the quarterlies every quarter, but for the sake of simplicity, let's just say he did it on a quarterly basis. 13. Okay, so now we're crediting the taxpayer for those amounts. We would want to then go read the 1040. And we can see here, okay, yeah, here's 50,000 each quarter, so that means he paid 200,000. And then on the state side, we can use the tax summary. Okay, here's the state estimated payments, 10,000 per quarter for $40,000. So that is crediting him for the tax that he's already paid. He's prepaid for 2012. Very important part of this tax return. When you see that person has a large amount of estimated tax paid from the previous year, they likely did that again this year. And that means that this guy knows, hey, I have 2 Schedule Cs for profitable businesses, which is acting and consulting, right? And then I also have this very large K1 payment from the profit of my corporation. So I'm going to need to pay some tax ahead of time to cover those taxes on the profits. Okay. So now we're in basically closing mode. We want to go check out the diagnostics. See, hey, is there anything wrong with this return? Anything else I should consider? Okay, the new rule. Okay. Okay. Computed. Okay. Question 1, 1099. Okay, so it looks like pretty clean return overall. At that point, I'm going to go to the tax summary page, and I'm going to take a look at the overall return, see how it's looking. Okay, you got a lot going on here, and I also want to get down to this bottom line and see, hey, how's my taxpayer looking? Oh, he's got a pretty big refund, 61,000, and that's likely because the profit, the profit from the S corporation this year was about $100,000 less in 2012 than it was in 2011. So he made estimated tax payments based on the higher amount, so it would make sense that he's going to get a little bit back. On the state of California side, let's see. Oh yeah, he still owes $8,000 to California. So before I'll show that to the client, I generally want to get an idea so I'm not surprised at the same time as the client is, whether they owe a ton or they're getting some back. I also want to look, here's that marginal tax rate, 35%. So he is at the maximum tax rate in 2012 on the federal side. And then on the state side, he's all the way up at 12.3% on his marginal rate. So that's going to be, what's that, 47.3% of his top part of his income is being taken for taxes. And that gets to that point that I was repeating about the value of his deductions. Every deduction that I don't get, every $100 deduction that he doesn't get, that I don't find, he's paying $47 more income tax than he needs to. And by contrast, every $100 deduction that I find, I'm saving him $47 in tax, right? Because his tax rate is 47%. So that really gets to the point of, that's why it's so important with this kind of client to really look for every single deduction. Make sure you're not missing, a carryover loss from Schedule D. Maybe he has a passive activity loss from the rental that could be carried forward. You got to really probe that tax return, the prior year tax return, and ask the client the right questions to see, hey, are we getting every single deduction that we can get? All right, it looks pretty good overall on this, and we would go through with the taxpayer, explain the situation. Okay, you have $88,500 on a W-2. That's your salary from your S corporation, from your job as the CEO of the company. Your interest income is $15,047. You have dividend income of $15,439. Remember, with the dividend income, since it's qualified dividends, you're getting that more beneficial tax rate. Instead of paying 35% tax on this $15,000, you're paying only 15%. Okay? So you're saving quite a bit. That's something I would want to point out. And when you point something out like that out to the client, it helps them make decisions. You know, like, oh, okay, maybe I want more dividend income, or maybe getting a lower tax rate for this guy because he has such a high marginal tax rate. Anything that any little tax breaks he can get like that, are make a difference, help him pay lower tax. Business income, sir, you came out with a both your Schedule C's are netted together. So you had on the acting Schedule C, you had a profit after your home office deduction as well of $34,614. On the consulting, you had $7,777 profit. So wait, I got to the good part already. Let's start. It's acting a little crazy. I'm jumping around. Sorry, guys. So you had between the two Schedule C's, you had 42,391 of net profit. You did have a capital gain this year on that BlackBerry stock that you sold. However, you had a carryover loss that we picked up from the previous year, which actually enabled you to take that gain tax-free, and you still ended up with a little negative here on your tax return. This $462,000 from the Schedule E represents your net profit. Let's see, your net profit $8,429 from your rental property, and then also Schedule E, page 2, the big item here. This is your K1, your profit distribution from your S corporation. Okay, so those are being netted together onto this line item, which is $462,000. So your total income this year had a pretty good year, $620,000. Not too shabby. You don't get taxed on your total income. Remember, you get to take what's called deductions. So deductions help us reduce your taxable income, which then reduces your tax. You get half of your self-employment tax as a deduction. That's your Social Security and Medicare tax from your Schedule C businesses. So 1907 minus that. You also get the self-employed health insurance. That's a deduction, minus, subtract. Penalty on early withdrawal of your CD, a California bank. They penalized you a little bit. We're taking that as a deduction. Alimony paid, that's also a deduction, a pretty big deduction at that, $36,000. So we just keep moving down the line. Now you have your itemized deductions. That's state and local income taxes, including those estimated tax payments that you made to California. You made $40,000 of estimated tax payments. We're using those as itemized deductions on the federal side. This is your mortgage interest, personal home, contributions. You were generous. Okay, you have 68,745 itemized deductions. Get subtracted from your income. Keep subtracting for those deductions. You have one exemption deduction for each dependent. In your case, you have one dependent yourself. Again, that gets knocked off here. Now you're at your taxable income, $503,679. So of your total income up here, this is how much is exposed to tax or subject to tax, $503,679. The federal income tax on that is $149,961. You do get a $25 foreign tax credit based on the foreign tax that you paid through your, I believe it was your dividends. Let's look that up. That was actually your interest income. So your 1099 INT, you had paid foreign tax of $25. We got you that credit. You do have some self-employment tax, Social Security and Medicare tax on your Schedule C business activities. Your total tax then is $153,317. This is your federal income tax bill for 2012. So you're definitely doing your part to support our country. Let's just put it that way. You had withholdings taken out. You also paid tax not only out of your W-2, but also out of your 1099 INT and your 1099 dividend income. You paid some tax ahead of time. You also paid $200,000 of estimated tax. Those are those quarterly payments that you made. So you have total credits in of $214,954. That's enough to pay your bill. So it pays your tax. And you actually have a really good refund, $61,637. So you get some of what you paid back. Okay? So that would be the good news. And last year you had a federal refund of 36,000, so you're close to doubling that amount. That would be the good news. On the state side, you can see this itemized deduction limitation. The state limits for high income people, limits the itemized deductions that can be taken. So state income tax is $57,038 for the year. You paid $8,592 in withholdings. Then you paid $40,000 of estimated tax payments. So your total payments in were $48,592. That's actually not enough to cover your state income tax. So you would owe state income tax bill of $8,446, which would cover the shortfall. Here's your tax bill, 57. Here's what you paid, 48.5. So you owe 8,446 on the state side. But the good news would be that you get a nice federal refund to help you pay that bill. All right, what else? Any questions, any ideas, any suggestions? Once you go through that spiel with the client, you definitely want, with somebody who's got some more moving pieces like this, maybe they have some ideas about, hey, I'm thinking about doing this. Like, what if, what if I was to do a regular 401k rather than a Roth 401k? Let me ask you about that. Let me ask you about this. What are some ideas for next year? This is a kind of high value client where, here's tax preparation fee on this return. $645 is what the forms are coming up as in our calculations. But this kind of tax return, you could probably get, $800, even $1,000 or more. Okay, and especially if you can provide some more value to that client and really be a resource for them. So hopefully, at this point, they would be impressed that, hey, you know how to handle this pretty well. You must have taken Pronto tax class, or whatever kind of compliments they want to throw your way, you'll be happy to take them. But not only just impress them with this tax preparation experience now, but the key thing with tax preparation, guys, is always to try to lock down the client for future years, and really solidify that relationship. So the conversation that you have after the tax return is done, and is already prepared, the conversation with the client, that's really where a lot of the you can kind of retain that client for future years. Or maybe hey, email me during the year if you have any questions. Or I'm happy to help you on a year-round basis with any questions you might have. Solidifying the relationship with this type of client is going to give you a base of fees, decent fees, where you can be able to make a living in this tax preparation game, which is, as you guys all know, is very competitive. So when something's competitive, you got to really look for a way to distinguish yourself, and providing great service to the person, to the client, is really going to be your best way to distinguish yourself as a tax preparer. All right. So yeah, that's one of the trickier returns. I think that's the trickiest return we've done so far on these practice tax returns. And I hope it wasn't too much overkill. I know I threw a lot of different things at you, probably talking really, really fast, especially if you're a beginner. But like I said, I just want to show you a return that has a lot going on, helps us to look at how a lot of the tax laws affect a client's actual amount of tax that they pay. And I feel like this tax return did a pretty decent job of that, so I'm happy about that. All right, guys, I got to get back to work, and I'll talk to you soon. Thanks a lot. Have a good one.